Good evening, folks, and welcome along to this evening's webinar. This is the first in a series of webinars that are designed to provide you with general information about your loan, purchasing property, and creating wealth. Our aim is to keep these webinars short and to the point so that you can refer back to these in the future and also pass them on to your friends if you feel this information would help them. Our topic this evening is using equity to purchase an investment property. Now, as a broker, this is a scenario that comes up frequently for me. I assist people to purchase their home, and after a period of paying down their loan and a combination with capital growth, they develop equity in their home. Many of these people want to know how they can use that equity to purchase an investment property. So tonight, we're going to get a handle on equity. We'll discuss why you would use it, how to calculate and access it, and then we'll look at a couple of different scenarios. However, before we move forward, there is a disclaimer that I need to read to you. This advice is for general information only. Before making financial decisions, you should seek independent advice from your financial advisor or an accountant. So what is equity? Well, in simple terms, equity is the difference between the market value of your property and the amount you still owe against the property. So in this example, we have a property that is valued at $500,000. It currently has a loan against it of $300,000. So the equity position in this example is $200,000. So that's a very straightforward version. Why would you access equity? Well, there are many different reasons why you may want to access your equity. You may need to increase the size of your home or modernise it. Today, home renovations often cost a lot, and most people have not been able to save for this, so they use the equity built up in their property to fund this. You may wish to take the holiday of a lifetime, however you do not have enough savings to pay for it. It may be time to upgrade the family car or purchase a major item for your home. As part of your investment strategy, you may wish to start a managed fund or purchase a parcel of shares. Or you may wish to purchase an investment property to help fund your retirement. Using the equity in your home can help to create or build your wealth by accessing other investments. Tonight, the investment stream that we will focus on is the investment property. Calculating your equity. This is undoubtedly where most people get a little confused in terms of understanding how much equity they have and what part of that equity they can access. Let's go back to our example where we have a property valued at $500,000 and you owe $300,000. You would like to access equity in your property. If you access $100,000 of equity, then you'll take your total borrowings up to $400,000. This represents 80% of the total value of the property. Now, this is important because at this point, you would not have to pay any lender's mortgage insurance as your total borrowings don't exceed the 80% loan to value ratio. You may have also heard this referred to as LVR. Now, you can potentially access another $50,000 of your equity. However, this would take your total borrowings above the 80% mark, and you would then be charged lender's mortgage insurance. And that's not only on the additional $50,000, but on the total borrowings of $450,000. This can become very costly. There are times when people do this, however, and this is generally because the return from the potential investment outweighs the LMI costs. Now, the next part is where most people make a mistake. The remaining $50,000 in equity can really only be accessed when you sell the property. In the past, some lenders would allow you to borrow up to 100% of the value of your property. However, in the current climate, the majority of lenders will cap your borrowings at 90% of the property's value. So how do we access equity? Well, essentially there's two ways to access your equity. The first is through a lump sum payout, and the second is through a drawdown or an equity facility. So let's look at these two different options. As a lump sum payout or drawdown, you would increase your current loan, and in this case it is by $100,000. You would then have the funds deposited into an account or drawn in the form of a cheque payable to whoever the funds needed to be transferred to. So in an example where you're purchasing a block of land, let's say for $100,000, you would have the bank draw a cheque to the vendor for the $100,000, and you would pass that cheque across at settlement. But let's say you didn't need to use all of the money at once. You wanted to draw down the funds as you needed them. In this case, you would establish an equity or drawdown facility. The facility would have a limit, and in this case it's $100,000. You would access the funds as you needed and only pay interest on the funds as you use them, as opposed to the lump sum payout option, where you start paying interest on the funds as soon as they are paid out to the loan. This option works really well in circumstances such as renovations, where you only need to pay the builder as work is completed, or someone who may wish to invest in a share portfolio and does not require all of their capital at once. Rather, they require the funds as opportunities present themselves. So what are the lender requirements when you want to access your equity? Well, the first thing that they will require from you is an application. Your lender will conduct a valuation of your property to determine its value, and you will need to demonstrate that you can afford to repay the new loan. In your application, you would need to disclose the purpose of the additional funds, and the lender may then require further documentation in relation to this. For example, if you are accessing equity to pay for renovations, then the lender may request builder's quotes or a fixed price building contract. If you are accessing equity for investment into shares or managed funds, then the lender may require to see a copy of your financial planner's statement of advice. If you wanted to purchase a car using your equity, then the lender may wish to see a copy of the sales advice from the car dealer. Or if you are accessing equity to purchase an investment property, then the lender may require to see a copy of an exchange contract on the new property before releasing the funds. So when do you need to access equity? Well, if you're thinking of using the equity in your property for renovations or investments, then before you start knocking down walls, buying shares or making offers on a property, you need to have your equity facility set up. So speak to your broker at the very beginning. Okay, now let's look at a couple of different scenarios. The outcomes in these scenarios are exactly the same, however there are two different ways of structuring this, and we'll go through the pros and cons of both. In this first scenario, we have your property valued at $500,000, and you have $300,000 in borrowings against it. You would like to purchase an investment property for $400,000. There are costs associated with the purchase, such as stamp duty, solicitor's fees, etc. So the total cost to purchase this property is approximately $415,000. Because you have sufficient equity in your home, in this scenario, the lender will actually fund the full purchase price of the investment property plus the additional costs. So when you add the two property values together, you have a total security value of $900,000. And by adding the two loan amounts together, you have $715,000 worth of debt. As an overall percentage, your total borrowings equal 79.5%. This is under the 80% LMI threshold, and no mortgage insurance would be payable. Now, this all seems easy, and often it is. However, you need to be aware that both properties will be tied together or cross-collateralized. This means that the lender secures both properties against the total debt and this can cause potential restrictions if you decide you wanted to refinance one of the properties to another lender in the future, or it could limit your options if you want to sell one of the properties. For example, if you sold your home for $500,000, you would have to pay down the debt against the investment property, and to what level would be dictated by the lender. In this second scenario, the outcome is the same, however the structure is different. So you have a property, and your property is worth $500,000, with a loan of $300,000 against it. We set up an equity facility or a drawdown facility for $100,000, and that is with the same lender. You then purchase an investment property for $400,000, and we use $95,000 from the equity loan to cover your 20% deposit plus the associated costs. We then set up another loan with a different lender that represents 80% of the purchase price. So our total security value is $900,000, and our total debt level is $715,000, thus representing a 79.5% loan to value ratio. Now, as you can see, our end numbers are exactly the same. However, we have added two further steps. The reason for this is to give your home some protection against any possible problems with the investment property. For example, your tenant stopped paying you rent and you cannot afford to repay the $320,000 loan by yourself. If that $320,000 investment loan falls into default and lender B is then forced to foreclose on the investment property, this is the worst case scenario. However, under this structure, lender B does not hold the title deeds to your home and therefore does not have the power to sell your home if there is a potential shortfall. We refer to this as spreading your risk across lenders or not putting all your eggs in one basket. Now, accessing equity to invest should always be part of a well thought out plan, and you should consult with your financial advisor or accountant before speaking with your broker. I hope you've enjoyed this evening's short presentation, and please contact me via email or on the number below should you wish to ask further questions or discuss your own personal circumstances.